So you want to know the secret to lowering your tax bill before you even get to the standard or itemized deductions? Well, we're talking about adjustments to income. And let me tell you, they're your first and most powerful line of defense in reducing what you owe. I mean, this is the big question every single tax season, isn't it? You work hard all year, you see that gross income number, but the real game is figuring out how much of that is actually going to be taxed. And that's exactly what we're going to break down today. And it all starts right here with your adjusted gross income, or AGI, as you'll hear it called. The best way to think about it is like a funnel. You pour all your gross income in at the very top, and then these special deductions, these adjustments, start filtering it down. What comes out at the bottom is your AGI. It's a smaller, much better number that becomes the starting point for your entire tax return. So what exactly are these deductions? Well, they're called above the line for a super simple reason. On the tax form, they sit literally above the line where your AGI is calculated. You'll find them all laid out on Schedule 1 of the Form 1040. Let's jump into some of the most common ones. Okay, first up, a really important one for our educators. You know, the tax code actually recognizes a simple fact. Teachers are constantly dipping into their own pockets for classroom supplies. So this is a small but important way to give a little something back. The rule itself is pretty straightforward, but it's powerful. If you're an eligible educator, any of that unreimbursed money you spend on things like books, supplies, or even computer equipment for your classroom, you can deduct that right off the top of your income. And here's the number you need to remember: $300. The maximum deduction is $300 per educator. Now, if you're married to another educator and you both have expenses, guess what? You can each take the deduction. That's a total of up to $600 on a joint return. It's a per-person limit, which is great. But you have to know the rules here are very specific. You've got to be a K-12 teacher, counselor, principal, or an aide, and you have to work at least 900 hours during the school year. And one key group that gets left out here: college instructors. They, unfortunately, aren't eligible for this particular deduction. All right, it's not just about what you spend on your job. The tax code also gives you a nice little reward for investing in your own future, specifically when it comes to your health and education. Let's look at two really big ones. So if you have a high deductible health plan, you can contribute to what's called a health savings account, or an HSA. And get this, every single dollar you put in is an above-the-line deduction. It is an amazing tool because it's what we call triple tax advantaged. You get a deduction today, the money grows tax-free, and you can pull it out tax-free for medical expenses. It's a win-win-win. And you know, for the millions of us paying off student loans, there is some relief here too. That interest you pay on qualified student loans, you can deduct it as an adjustment to your income. That directly lowers your taxable income, which is a huge help. And here's that magic number. You can deduct up to $2,500 in student loan interest every year. Now, it's not unlimited, I know, but that can still make a really meaningful dent in your final tax bill. But, and this is a big but, there's a catch. This deduction is really designed for low to middle income folks. As your income starts to climb, the amount you can deduct starts to phase out, and eventually it just disappears for higher income taxpayers. So you always want to check the income limits for the current year. All right, let's switch gears and talk about a group with some of the most powerful above-the-line deductions out there: the self-employed. If you work for yourself, you're basically wearing two hats. You're the employee and the employer, and the tax code definitely reflects that. And this little chart illustrates perfectly why those deductions are so important. As a normal W-2 employee, right, you pay 7.65% for Social Security and Medicare, and your company matches it. But when you're self-employed, you're on the hook for both halves. That's the full 15.3%. That is a big, big number. So to kind of level the playing field, the tax code lets you deduct the half that you paid that would have been your employer's share. It's a direct adjustment to your income, basically acknowledging that part of what you paid is a business expense. Makes sense, right? And here is another huge one. If you're self-employed and you're paying for your own health insurance, you can usually deduct 100% of the premiums you paid. And not just for you, but for your spouse and your dependents under 27 too. This isn't an itemized deduction. It's an adjustment that directly whittles down your AGI. Now, there is one major rule you have to remember here. This deduction can't be more than your business's net profit. You can't use this deduction to create a business loss. Your business has to be profitable for you to be able to claim it. So, okay, we've looked at a few specific adjustments, but why are we so obsessed with this one number, the AGI? Well, because its impact goes way beyond just this first step. It literally creates a ripple effect all the way down your tax return. See, a lower AGI can be the key that unlocks a bunch of other tax benefits. For instance, your ability to deduct medical expenses is limited to the amount that's over 7.5% of your AGI. So the lower your AGI, the lower that hurdle is, and the easier it is to actually claim that deduction. It's the same story for so many other credits and deductions. They all hinge on that one critical AGI number. Look, at the end of the day, these adjustments are your first and best tools for really shaping your tax outcome. From educator expenses to HSAs and those really powerful deductions for the self-employed, every single one helps reduce that all-important AGI. So the real question is, which of these tools are in your toolkit?